Thus, we're blockchain is much more effective than traditional rails and controlling what robots do. I mean, to give an example, whether it's authentication or identity or payment speed, all of these work better on crypto systems. And you're going to ask yourself, well, why hasn't this reflected in crypto prices? That's because the stock market is still working its way downstream. The future infrastructure of AI is going to be our crypto. So to me, it makes perfect sense that we're just working our way through, and I think this is just a matter of months. So if you're bearish, you are selling at the bottom. And again, I can't emphasize, I think if you're bearish today, you are bearish in the bottom to Bitcoin and a euro.
Over the past few weeks, crypto investors have been forced to watch one of the most frustrating market environments of this entire cycle unfold. Bitcoin has struggled to maintain momentum, Ethereum has repeatedly failed to attract sustained buying pressure, and many altcoins have suffered even deeper losses. What's making the situation even more painful is that, until recently, traditional markets appeared unstoppable. Stocks pushed to record highs, AI-related companies attracted enormous amounts of capital, and investors were told that risk assets were entering a new golden age. But then everything changed suddenly on Friday. In a single trading session, more than $2.5 trillion was wiped out across global markets. The S&P 500 lost over $1 trillion in value. The Nasdaq suffered one of its sharpest declines of the year. Gold and silver were hit hard. Bitcoin fell more than 6%. Suddenly, every major asset class was moving lower together. What started as a market built on optimism quickly turned into a market driven by uncertainty. The trigger was a perfect storm of events. A surprisingly strong jobs report reignited fears that inflation could remain elevated for much longer than investors expected. Oil prices remained stubbornly high. Questions began to emerge about whether the AI boom had become overheated after disappointing reactions to major earnings reports and concerns about future demand. At the same time, investors are preparing for a massive wave of capital raising from some of the world's most valuable private companies, while a new Federal Reserve chair prepares for his first policy meeting under intense pressure. The result is a market that suddenly looks far less predictable than it did just days ago. And yet, despite all of this negativity, not everyone believes the outlook is bearish. In fact, some of Wall Street's most respected market analysts believe crypto may be much closer to a major turning point than most investors realize. In today's video, we're going to hear two very different but equally important perspectives. Fundstrat's Tom Lee believes crypto is sitting near an important bottom and that several powerful catalysts could soon emerge. Meanwhile, macro analyst Luke Gromen is taking a far more cautious approach, warning that liquidity conditions may still be working against Bitcoin and risk assets. Together, their insights paint a fascinating picture of where markets could be heading next. Before we get into it, if you enjoy our market breakdowns and want to help us continue bringing you analysis from some of the biggest names in finance and crypto, please take a moment to like this video, subscribe to the channel, and share it with someone who follows the markets. Also, let us know in the comments, do you agree more with Tom Lee's bullish outlook or Luke Gromen's cautious approach? We'd love to hear your thoughts. Now let's get into it.
Oil is the root driver of inflation. So if there's an inflation problem created by oil, then it means central banks have to be tight globally. And that's actually what we're saying. Oil prices have gone up. Petroleum products have been supplies and then were severely impacted. And our policymakers have to raise interest rates. So if the war ends, I think that you're going to see a collapse in oil. In fact, if any of you are technicians, you know that this is probably likely, that if the war ends, the tariff premium will come out of oil, and then at least see $40. Ethereum has huge negative correlation to oil right now. In fact, it's the highest inverse correlation ever in the history of Ethereum. So clearly, rising oil is negative for ETH price. You can see it statistically. And if you don't believe me about inflation and oil, take a look at this chart. This chart starts 1985. The top chart is the price change of oil. The bottom is your CPI. And as you can see, every time we hit a sustained spike in oil, core CPI accelerates higher. So if this is a long war, we're going to have inflation. And in fact, the FOMC last month said the same thing. In their minutes, they said that policy firming would be appropriate if inflation were to continue and persist above 2%. So central banks don't want inflation above 2%. Oil stays high, they're going to be hawkish. However, we're betting on a war that ends soon. The second positive catalyst on the macro is the Clarity Act. It's a huge deal. We all know why Clarity Act matters. Basically, it provides a legitimate framework for crypto to proliferate in the US, but also with financial institutions to build. But unfortunately, the market only believes there's a 56% chance Clarity Act gets signed this year. Now, I've talked to a lot of folks in Washington, including our policy experts. It does seem like the odds are much higher. The prediction markets are trying to find equilibrium, but I do think probability of passage is much higher than 56%. But of course, we know that big banks don't want this to happen. But keep in mind, the big banks don't write policy. Laws are to represent people, and that's why we have to keep in mind there are a lot of constituents that want to see a Clarity Act passed. If that passes, it's a big catalyst. The third positive catalyst is, of course, don't forget the White House is a very pro-Bitcoin, pro-crypto White House. It's also very good for the US dollar policy, especially with regard to stable points. The fourth is we have a new Fed chair, Kevin Warsh, and Kevin Warsh is pro-Bitcoin. And finally, the stock market has a massive tailwind. I know a lot of you guys may be bearish on equities because you think they've run too far, but at FunStrap, which is another hat I wear, we've been bullish on stocks structurally, and a lot of it has to do with this chart. This chart is the number of people in America aged 30 to 50. Every time it goes up, the US economy will grow faster than trend. And we are seeing this above trend because of millennials, Gen Z, and Gen Alpha. And as you can see on this chart, if you overlay equity returns with the number of people aged 30 to 50, the stock market has always risen parabolically. And this tells us that markets in the S&P could be 15,000 to 18,000 by the end of this decade. So these are the tailwinds for crypto. But of course, you're still going to wonder why crypto is so weak. And I think it's because people are forgetting that crypto is the future of money. Okay, the first thing I want to cover is agentic in robotics and why crypto will play a role. This is a list of all the milestones since ChatGPT was introduced in 2023. Okay, and there's been significant advances in the last 3 years. Of course, the first was the launch in ChatGPT. The second, which happened in 2024, was when the agent systems began to develop capabilities to work with websites, interactive websites. Then the third big advancement has been robotics. Optimus Prime and their dexterity, and of course the new Crane building drones at industrial scale. And then finally, we're seeing superhuman capabilities develop. So OpenAI developed a solve an 80-year-old puzzle, and then Vigor AI launched a robot that actually builds and operate at scale in a warehouse. So that means the future robots are already going to dominate most traffic on the internet. And this is why Mark Andreessen and others have talked about this as being the reunification, because if you got a robot system, you're going to have to control them. And that's where blockchain is much more effective than traditional rails and controlling what robots do. I mean, to give an example, whether it's authentication or identity or payment speed, all of these work better on crypto systems. And you're going to ask yourself, well, why hasn't this reflected in crypto prices? That's because the stock market is still working its way downstream. The first group that really benefited from the AI ecosystem was the semis. They're still going up. And then last year was memory stocks, and they're still in the process of re-rating. But as you can see, the market's starting to now see the AI benefit to the max, and it's working its way to software. people thought software was you lose with AI, but you can see this little parabolic spike. Software companies are benefiting from AI because they're developing the downstream applications. And finally, the future infrastructure of AI is going to be our crypto. So to me, it makes perfect sense that we're just working our way through. And I think this is just a matter of months.
Tom Lee's argument ultimately comes down to a simple idea. The market may be focusing too much on short-term fear, while ignoring the bigger structural forces developing underneath the surface. From his perspective, concerns about inflation and oil prices are important, but they are temporary obstacles. If geopolitical tensions ease and energy prices decline, inflation pressures could quickly fade. Giving central banks more flexibility and removing one of the biggest headwinds facing crypto today. Combined with favorable regulatory developments, a supportive political environment, and strong demographic trends supporting economic growth, Lee sees multiple catalysts lining up at the same time. Perhaps even more importantly, Lee believes investors are underestimating crypto's role in the future of artificial intelligence. As AI systems become increasingly autonomous and robotics continue advancing, he argues that blockchain technology will become essential infrastructure for authentication, identity, payments, and machine-to-machine transactions. In his view, the market is simply moving through the AI investment chain, with semiconductors and software benefiting first before capital eventually flows toward crypto. But while Lee sees the current weakness as an opportunity, our next speaker believes recent price action may be sending a more cautious message. Here's Luke Gromen.
Have you started buying back in, or are you waiting for Bitcoin to crash lower? Because it's not doing well in these last couple of days.
No, it's had a tough couple of days. I nibbled a little bit, but basically the answer is no. I have not really bought back in any real way. I didn't sell it all, but I sold most of it. So the answer is no, I haven't. And so I'm watching with interest here. The way it's been trading, particularly the last 3-4 days. It's had a bit of a rough stretch, and I think there's potential information in that. Let's see.
Can you break down why you think this is happening when we're seeing such momentum in stocks? We keep seeing the all-time highs. This is almost reminding me on the stock side of 2021, right? Every other day, all-time high, all-time high. But Bitcoin was doing so well back then. We were in a bull run. So what's the disconnect here?
I don't know for sure. My working hypothesis is if you look at sort of the underpinnings of this market run, they're not really healthy, actually. The headline indices, yes, all-time high, all-time high, all-time high. And it's like 7 stocks. Just saw a chart yesterday that X things related to AI, the S&P 500 is flat to down slightly from the day before the Iran war started. If you take US, MSCI US, and then MSCI emerging market, and you take TSMC, Samsung, and another big AI/memory related name, I can't think of it, out of the US or the MSCI EM, it looks on the surface like EM is crushing the US. But if you take those 3 or 4 AI related names out, EM's actually getting crushed. So there's these, we've seen the stuff about breadth. And I think that's, breadth of the market's very, very poor for where we are in terms of the headline indices. And I think what's ultimately happening is AI is sucking all the oxygen out of the room, all the liquidity out of the room. And it's all in one area. And I think that's happening to Bitcoin as well. I think it's a victim of that as well. And, as we've talked about many times, I think Bitcoin's one of, if not the last functioning smoke alarm of liquidity. And it's telling us not good things. Now, at the same time, we also have oil sucking liquidity out of the room, and we are doing everything we can to try to keep oil down. The Trump administration, the U.S. doing everything they can to try to keep oil down, mostly via jawboning, Western SPR releases, etc. But oil's up 50% from even at these relatively lower levels. It's up 50% since the war started, so give or take. So I think you got oil sucking oxygen out of the room, commodities sucking oxygen out of the room, AI sucking oxygen out of the room in terms of liquidity, and everything else that isn't one of those 3 things or directly related to it. They're not doing that well. They're flat to down.
The contrast between Tom Lee and Luke Gromen is what makes this discussion so valuable for investors. Both men recognize the long-term significance of Bitcoin, blockchain technology, and the broader digital asset ecosystem. Neither is arguing that crypto's future has disappeared. The difference lies in how they interpret the present moment. Tom Lee sees a market approaching an inflection point. He believes inflation concerns could ease, regulatory clarity could improve, and AI adoption could ultimately create enormous demand for blockchain-based infrastructure. From that perspective, today's fear may look very similar to previous moments when investors became excessively bearish near important lows. His message is clear. Don't allow short-term volatility to blind you to long-term opportunity. Luke Gromen, however, is paying closer attention to liquidity. While stock indexes continue making headlines, he sees a market increasingly concentrated in a small number of AI-related winners. Capital is flowing toward artificial intelligence, energy, and commodities, while other sectors struggle to attract investment. In his view, Bitcoin's recent weakness may not be random at all. Instead, it could be signaling that liquidity conditions remain tighter than many investors appreciate. Until those conditions improve, he believes caution remains warranted. The reality is that both perspectives can be true at the same time. Crypto may indeed be approaching a powerful long-term opportunity while still facing significant short-term challenges. Markets rarely move in straight lines, and some of the strongest bull markets in history have emerged from periods of maximum uncertainty. The key question for investors is whether current weakness represents the end of the story or simply another chapter within a much larger trend. As always, the coming weeks could prove extremely important. Between Federal Reserve decisions, developments in the AI sector, geopolitical events, energy markets, and evolving crypto regulation, investors have no shortage of catalysts to monitor. Whether you lean toward Tom Lee's optimism or Luke Gromen's caution, one thing is certain: this is not a market environment that can be ignored. If you found this analysis helpful, please support the channel by liking the video, subscribing if you're new, sharing it with friends and fellow investors, and leaving a comment below with your thoughts on where Bitcoin and crypto are headed next. Don't forget to check out our other videos covering the latest developments in crypto, macroeconomics, and global markets. Thank you very much for watching, and we'll see you in the next video.